Have you ever wondered what's in your wallet? I don't just mean cash or cards, but the history behind them. The story of money is the story of power, empires, and the very foundation of civilization. Let's travel back in time, over 5,000 years, to ancient Mesopotamia. Here, in the cradle of civilization, the first empires, like the Akkadian and Babylonian, rose. They didn't have coins. Instead, they used a system based on barley. Imagine paying your taxes in sacks of grain. The government would collect this barley, store it in massive temples, and then use it to pay soldiers, builders, and administrators. They also used standardized weights of silver, like the shekel. This wasn't just about trade, it was a powerful tool of control. By setting the value of barley and silver, the rulers controlled the economy. They could fund massive armies and build incredible cities like Babylon, all powered by grain and precious metals. This system, known as a commodity money system, was the economic engine of the first empires. Now, let's journey west to the Mediterranean, to an empire that would define the course of Western history, Rome. The Romans were masters of engineering, law, and warfare. But one of their most powerful tools was a small, silver coin, the denarius. Around the 3rd century BC, Rome began minting its own currency. Each coin was stamped with the image of an emperor or a symbol of Roman power. This was brilliant propaganda. Every time a merchant in Gaul or a farmer in Egypt used a denarius, they were holding a piece of Roman authority in their hand. It was a constant reminder of who was in charge. The Roman monetary system was incredibly sophisticated. It allowed them to pay their legendary legions, fund the construction of roads and aqueducts across 3 continents, and create a vast, integrated market. Goods flowed from Britain to Syria, all lubricated by a common currency. But this system also held the seeds of its own destruction, as emperors needed more money to fund wars and lavish projects. They started debasing the currency, mixing less silver with cheaper metals. People lost faith in the money, inflation skyrocketed, and the economy faltered. The collapse of the Roman currency system was a major factor in the fall of the Western Roman Empire. It's a powerful lesson. A strong empire needs sound money. After the fall of Rome, Europe splintered. For centuries, the dream of a unified empire seemed lost, and so did the idea of a single, dominant currency. Local lords and kings minted their own coins, leading to a chaotic and fragmented economic landscape. Trade was difficult, and large-scale projects were nearly impossible. But then, from a small island nation, a new global power began to emerge: the British Empire. How did a tiny island come to rule a quarter of the world's population? There are many reasons, but a crucial one was the pound sterling. Beginning in the 18th century, Britain established itself as the world's leading commercial and industrial power. The British pound, backed by a stable government and, eventually, the gold standard, became the world's reserve currency. The gold standard meant that every pound sterling was convertible into a specific amount of gold. This created immense trust and stability. From Hong Kong to Canada, from India to South Africa, the pound was king. International trade was priced in pounds, and London was the financial center of the world. This monetary dominance gave Britain enormous power. It could finance its vast navy, fund colonial administrations, and project its influence across the globe. The British Empire wasn't just built on ships and soldiers. It was built on the unwavering reliability of its currency. Just like the Roman denarius, the pound sterling was more than just money. It was a symbol of imperial might and a tool for global expansion. From Mesopotamian barley to the Roman denarius and the British pound sterling, the story is remarkably consistent. Controlling money means controlling the state. A stable, trusted currency allows empires to raise armies, build infrastructure, and project power far beyond their borders. It unifies diverse territories under a single economic framework, making the emperor's or the crown's authority felt in every marketplace transaction. Today, we live in a world of complex financial systems, digital currencies, and shifting economic powers. The US dollar has held the role of the world's primary reserve currency since the end of World War II, granting the United States a similar kind of influence once held by Rome and Britain. But as history shows us, no empire and no currency reigns forever. New economic powers are rising, and the future of money is being written as we speak. So the next time you look at the money in your hand, remember the empires it represents. It's not just paper or metal, it's a piece of history, a symbol of power, and a clue to the future of our world. Thanks for watching. If you found this journey through monetary history fascinating, be sure to like this video, subscribe to the channel, and hit that notification bell so you don't want to miss our next exploration into the forces that shape our world. See you next time.
A currency system is not simply a collection of coins in circulation. It is a framework of authority, trust, and obligation. To understand how the first currency systems created economic power, we must look beyond the metal itself and examine the mechanisms that made it effective. At its core, a functioning monetary system rests upon three pillars: standardization, credibility, and enforceability. Standardization is the foundation. In early economies, trade depended on barter or weighed quantities of precious metals. But barter is inefficient, and silver by weight lacks uniform certainty. Once a state stamps metal with a guaranteed weight and purity, it removes ambiguity. Transactions accelerate, markets expand, economic activity becomes scalable. The Roman Empire mastered this principle. By issuing consistent coinage across vast territories, Rome reduced friction in trade from Britain to the Near East. A merchant in Gaul could transact with confidence because the coin in his hand carried imperial assurance. Yet standardization alone is insufficient without credibility. The value of a coin ultimately depends on trust in the issuing authority. When Roman emperors debased the denarius, reducing its silver content to finance military campaigns and state expenditure, the consequences were predictable. Prices rose, confidence faltered, inflation eroded purchasing power. What appeared to be a convenient fiscal strategy became a hidden tax on the population. The lesson was clear: currency integrity underpins state stability. Britain absorbed this lesson over centuries. Medieval monarchs frequently faced the temptation to debase coinage in times of fiscal strain. However, repeated cycles of debasement and restoration demonstrated that long-term power required monetary discipline. Stability encouraged trade. Trade increased taxable wealth. Taxable wealth strengthened the crown. Over time, this evolved into a deeper understanding of financial mechanics, that credibility reduces the cost of borrowing. The emergence of the pound sterling as a reliable unit of account marked a significant shift in UK finance history. Sterling was not merely a coin but a measure of value recognized in contracts and ledgers. As England's commercial networks expanded, the pound's reputation for consistency enhanced its acceptance beyond domestic borders. This credibility would later prove decisive. The most profound transformation occurred in 1694 with the founding of the Bank of England. Established to finance government war expenditure, it introduced a new model of banking power. Instead of relying solely on metallic reserves, the state could now issue debt instruments, government bonds, purchased by investors. In return, the bank received authority to issue banknotes backed by that debt. Money and government borrowing became intertwined. This innovation altered the mechanics of power. A credible state could borrow large sums at relatively low interest rates because lenders trusted repayment. That borrowed capital financed naval expansion, infrastructure, and global trade. The system effectively converted confidence into capability. Where earlier empires relied primarily on conquest for wealth, Britain increasingly relied on organized credit markets. The relationship between currency and debt is central to understanding empire finance. A stable currency lowers borrowing costs. Lower borrowing costs enable sustained military and commercial expansion. Expansion generates revenue, which reinforces confidence in the currency. It is a self-reinforcing loop until confidence weakens. Importantly, taxation anchored the entire system. By requiring taxes to be paid in sterling, the British state ensured continuous demand for its currency. Colonies trading within the imperial system operated through sterling-based settlements, binding economic activity to London's financial center. The pound sterling thus became both a domestic instrument and an international one. Over time, metallic currency gave way to increasingly abstract forms of money: paper notes, bills of exchange, credit instruments. Yet the principle remained unchanged. Economic power flows from the ability to issue trusted currency and manage debt responsibly. Banking institutions amplified this effect by mobilizing savings into productive investment. By the 18th and 19th centuries, Britain's financial mechanics were sophisticated. National debt markets were liquid. Investors across Europe sought British government bonds as secure assets. The pound sterling functioned as a reference point in global trade. What began as stamped metal had evolved into a complex system of credit and institutional trust. In this transformation lies the essence of banking power. It is not merely the accumulation of gold that grants dominance, but the ability to organize capital through credible monetary structures. The first currency systems created economic power by making value measurable and enforceable. Britain refined that model by making it scalable, turning trust itself into an instrument of expansion.
Have you ever wondered why the US dollar is the king of global currencies? Well, it wasn't always this way. For over a century, another currency ruled the world, a currency that built an empire and defined an era of global finance. I'm talking about the British pound sterling. Today, we're going on a journey through time to uncover the epic story of the pound, its rise to global dominance, and its dramatic fall from grace. This isn't just a story about money, it's a story about power, war, and the shifting tides of history that shaped the very world we live in. So, grab your tea and let's dive into the fascinating history of the pound sterling. Our story begins in the 19th century, the golden age of the British Empire. Picture this: Britain is the world's workshop, the heart of the Industrial Revolution. Its factories are churning out goods, its ships are crisscrossing the oceans, and London is the undisputed center of global finance. At the core of this vast economic machine was the pound sterling. But what made it so special? The answer lies in two words: the gold standard. In 1821, Britain officially adopted the gold standard, promising that anyone could exchange their pounds for a fixed amount of gold. This wasn't just a policy, it was a rock-solid guarantee. For international traders and foreign governments, this meant the pound was as good as gold. It was stable, reliable, and trustworthy. If you were a merchant in Shanghai selling tea or a banker in New York financing a railway, you did your business in pounds. Why? Because you knew its value was secure, backed by the immense gold reserves sitting in the vaults of the Bank of England. This system created a virtuous cycle. As more countries traded with Britain, they started holding pounds as their reserve currency. Central banks from Paris to Tokyo kept their savings in sterling because it was the most convenient and secure way to settle international payments. London's financial institutions, like its banks and insurance markets, flourished. They offered loans, insured cargo, and managed investments for the entire world, all denominated in pounds. By the late 1800s, over 60% of global trade was invoiced in sterling. The pound wasn't just Britain's money, it was the world's money, was the financial bedrock of an era of unprecedented globalization, all under the watchful eye of the British Lion. But as the 20th century dawned, the ground began to shift. The first major blow came with the outbreak of World War I in 1914. This was a conflict on an unimaginable scale, and it came with an unimaginable price tag. To fund the war effort, Britain had to spend its vast wealth. It sold off overseas assets, took on massive debts, primarily from the United States, and printed huge amounts of money. The most critical decision was to abandon the gold standard. The promise that a pound was as good as gold was broken, and the currency's stability was shattered. After the war, Britain was a shadow of its former self. It was no longer the world's biggest creditor. It was a major debtor. Its industrial dominance was challenged by rising powers like the United States and Germany. Despite this, there was a desperate attempt to restore the old order. In 1925, Winston Churchill, then Chancellor of the Exchequer, made the fateful decision to return Britain to the gold standard at its pre-war parity. This was a matter of national pride, an attempt to prove that the pound was still the king. However, this was a catastrophic mistake. The British economy was far weaker than it had been before the war, and the pound was now massively overvalued. British exports became too expensive on the global market, leading to mass unemployment and economic stagnation. Meanwhile, the United States was booming. Wall Street was emerging as a new financial powerhouse, and the US dollar, also backed by gold and a much stronger economy, was starting to look like a very attractive alternative. The 1929 Wall Street crash and the ensuing Great Depression was the final nail in the coffin for this era. In 1931, facing a run on its gold reserves, Britain was forced to abandon the gold standard for good. The pound's crown was slipping, and its credibility was in tatters. The Second World War delivered the final, decisive blow. Once again, Britain poured its remaining resources into fighting a global conflict. It liquidated more of its overseas investments and accumulated even more staggering debts to the United States through programs like Lend-Lease. By the end of the war in 1945, the economic landscape had been completely redrawn. The United States emerged as the undisputed economic and military superpower. It held 2/3 of the world's gold reserves and possessed an industrial base that was not only unscathed, but had grown immensely during the war. Britain, on the other hand, was victorious but bankrupt. The New World Order was officially cemented in 1944 at the Bretton Woods Conference in New Hampshire. Here, delegates from 44 allied nations gathered to design a new international financial system. The outcome was clear. The US dollar would replace the pound as the world's primary reserve currency. Under the Bretton Woods system, a dollar was pegged to gold at a fixed rate of $35 per ounce, and all other currencies were pegged to the dollar. The dollar became the new anchor of global finance, the standard by which all other currencies were measured. For the pound, the post-war years were a period of managed decline. The sterling area, a bloc of countries that pegged their currencies to the pound, began to unravel as the British Empire disintegrated. A series of currency crises in the 1950s and 60s further eroded confidence. The most humiliating moment came in 1967 when the government was forced to devalue the pound, a public admission that it could no longer maintain its value against the dollar. The final chapter in this transition came in the early 1970s when the Bretton Woods system itself collapsed, and the world moved to a system of floating exchange rates. By then, the dollar's dominance was an established fact, and the pound had settled into its new role as a major but not a dominant global currency. So, what can we learn from the pound's epic journey? The story of sterling's rise and fall is a powerful lesson in how economic power and global influence are intertwined. A dominant reserve currency needs more than just a history. It needs a powerful, productive economy, political stability, and the trust of the world. Britain had all of this in the 19th century, but two devastating world wars stripped it away, paving the path for the rise of the United States. Today, we see new economic powers emerging, and discussions about the future of the dollar are common. The tale of the pound serves as a potent reminder that in the grand theater of global finance, no reign is eternal, and the tides of history are always in motion. Thank you so much for joining me on this historical deep dive. It's a fascinating subject that really puts today's world into perspective. If you enjoyed this video and learned something new, please hit that like button and subscribe to the channel for more stories from the world of economics and history. Let me know in the comments what you think. Could another currency ever replace the US dollar? I'd love to hear your thoughts. Thanks for watching, and I'll see you in the next one.
By the 19th century, the financial architecture Britain had constructed was unmatched. The pound sterling was not simply a domestic currency. It had become the organizing principle of global trade. Commodities were priced in sterling. International contracts were settled through London. Insurance markets, shipping finance, and sovereign lending all converged in the city. Economic power had matured into financial dominance. At the height of the British Empire economy, this monetary influence extended across continents. Colonies held reserves in sterling, trade routes linking Asia, Africa, and the Americas often cleared through British banks. The gold standard reinforced confidence, anchoring the pound to a fixed quantity of gold and projecting an image of unwavering stability. For much of the 19th century, this system functioned with remarkable effectiveness. Britain could borrow at lower rates than its rivals. Investors trusted its institutions, capital flowed into London from across the globe. The financial systems that enable expansion also carry hidden vulnerabilities. Britain's dominance depended on a delicate balance, credible debt, disciplined fiscal management, and continued industrial leadership. As long as trade surpluses and industrial output remained strong, the pound sterling's position seemed secure. Yet beneath the surface, structural pressures were building. Industrial competitors emerged with formidable speed. The United States and Germany expanded their manufacturing capacity and technological innovation. Their economic output began to rival, and in certain sectors surpass, Britain's. Global markets became more contested. The foundation of British financial leadership, once underpinned by industrial supremacy, began to erode. The first decisive rupture came with the First World War. War finance required unprecedented borrowing. Britain suspended the gold standard to fund military expenditure, accumulating vast debts, particularly to the United States. What had once been a system of confident lending now became a network of obligations. The war altered the balance of financial power. London, previously the world's principal creditor, began its transformation into a debtor. Attempts to restore pre-war monetary stability proved fraught. In 1925, Britain returned to the gold standard at a rate many economists consider overvalued. The decision aimed to preserve sterling's prestige, but it imposed deflationary pressure on the domestic economy. Exports suffered, unemployment rose, financial credibility was defended at the cost of industrial competitiveness. The strain was evident. The interwar period exposed deeper fragilities. The global financial system, increasingly interconnected, transmitted shocks rapidly. The Great Depression intensified currency instability. By 1931, Britain abandoned the gold standard once again. The symbolism was profound. The anchor of 19th century financial dominance had slipped. The Second World War compounded the strain. Once more, war was financed through heavy borrowing. Sterling balances accumulated in the accounts of colonies and allied nations, creating future repayment obligations. After 1945, Britain faced not only reconstruction at home, but also the gradual dismantling of its empire abroad. The economic model that had sustained imperial reach was no longer sustainable under mounting debt burdens. Meanwhile, financial leadership shifted across the Atlantic. The United States, relatively strengthened by wartime production and holding significant gold reserves, assumed the central role in the new Bretton Woods system. The dollar, not the pound sterling, became the primary reserve currency. London remained influential, but it no longer commanded unquestioned dominance. Currency crises in the post-war decades underscored the transition. Repeated devaluations of sterling signaled diminished confidence. Each adjustment reflected structural realities: slower growth, rising obligations, and reduced geopolitical leverage. The financial mechanics that once empowered expansion now constrained policy choices. The turning point was not a single dramatic collapse, but a gradual realignment. Economic power shifted as confidence shifted. The British Empire economy, once integrated through sterling networks, fragmented into independent national systems. Monetary sovereignty returned to former colonies. London adapted, reinventing itself as a global financial center within a different order, yet the era of imperial monetary command had ended. History reveals a consistent pattern. Currency dominance amplifies power, but it also magnifies exposure. Debt that fuels expansion can, under altered circumstances, accelerate decline. Britain's experience demonstrates how financial decisions, gold parity, war borrowing, exchange rate policy, shape geopolitical outcomes over decades. In the end, the erosion of sterling's supremacy did not occur through sudden catastrophe, but through accumulated pressures. Industrial competition, global conflict, and debt cycles converged to reshape the balance of power. The architecture that once sustained empire gradually became the structure through which its limits were revealed.